Every 4 years, the same thing happens in Bitcoin. Prices crash. People panic. Headlines declare Bitcoin dead. And then, quietly, institutions start buying. Not because they're emotional, not because they're late, but because they understand Bitcoin cycles in a way most retail investors never do. If you want to understand Bitcoin the way institutions see it, not through hype, not through fear, but through data, cycles, and long-term structure, make sure you're subscribed. This channel is built for investors who want to think like smart money, not react like the crowd. Most retail investors experience Bitcoin cycles emotionally. They buy when price is rising. They feel smart during bull markets. They feel panic during crashes. Every cycle, they promise themselves, next time, I'll buy early. And every cycle, they still end up buying late. Why? Because retail sees Bitcoin as price. Institutions see Bitcoin as a cycle-driven asset. In this video, I'll break down Bitcoin cycles exactly the way institutions understand them. We'll look at how capital flows through different phases, why crashes are not accidents, and why the biggest money is made when Bitcoin feels boring or broken. This is not about predicting tops and bottoms. This is about understanding where we are and what that means. Core idea: Bitcoin moves in cycles, not straight lines. Institutions never ask, is Bitcoin going up tomorrow? They ask, which phase of the cycle are we in? Bitcoin moves through repeating psychological and structural phases. Accumulation, expansion, distribution, decline. Retail reacts to price. Institutions position based on phase. This single difference explains most of the performance gap. Accumulation, where institutions buy. Accumulation is the most uncomfortable phase. Prices are low. Sentiment is negative. News is bearish. Retail interest is gone. This is where institutions quietly build positions. They don't buy all at once. They accumulate slowly over months. They expect boredom, not excitement. Retail avoids this phase because it feels risky. Institutions love it because risk is actually lowest here. Most people don't notice this. The best opportunities never feel good in real time. Early expansion, smart money confirmation. As accumulation ends, price begins to move, not aggressively, but consistently. Volatility returns. Structure improves. Confidence starts rebuilding. Institutions don't chase here. They add selectively if structure holds. Retail is still skeptical. This is the phase where people say, let's see if it pulls back. This hesitation allows smart money to stay ahead. Full expansion. Retail enters. This is the phase everyone remembers. Prices accelerate. Media turns bullish. Influencers appear. Retail finally feels safe. FOMO takes over. Institutions stop buying here. They start managing risk. Retail thinks the cycle is just beginning. Institutions know it's already advanced. This is where retail usually gets trapped. Confidence peaks right before risk does. Distribution. Institutions exit quietly. Distribution doesn't look like a crash. It looks like strength. Price holds high levels. Good news continues. Retail remains bullish. But smart money is selling into liquidity. Not all at once. Not publicly. Gradually. Retail mistakes stability for safety. Institutions see exhaustion. Decline. Reset phase. Eventually, support breaks. Fear returns. Narratives collapse. Retail panics and sells, often at a loss. Institutions step back and wait. They don't rush. They know the cycle isn't over. It's resetting. This phase clears excess leverage and weak hands. Why institutions love crashes. Retail sees crashes as failure. Institutions see crashes as opportunity. Crashes reset risk. They restore asymmetry. They create favorable long-term entries. This is why institutional interest often increases when price feels most uncomfortable. Halving. Cycle accelerator. One structural element institutions pay close attention to is the Bitcoin halving. It doesn't guarantee price increases, but it changes supply dynamics. Institutions don't buy the halving event. They position around the cycle it influences. Retail trades headlines. Institutions trade structure. Time horizon. The biggest advantage. Institutions don't need immediate results. They operate on multi-year horizons. They allow volatility. They expect drawdowns. Retail wants fast confirmation. Institutions want long-term probability. Time is their greatest edge. Here's the uncomfortable truth. Most people don't lose money because they're wrong. They lose because they're impatient. Risk management. HOW institutions survive. Institutions never go all in. They scale entries. They respect invalidation. They assume uncertainty. They manage exposure. Retail assumes certainty and gets punished when markets change. Where WEARE matters more than predictions, institutions don't ask, "How high will Bitcoin go?" They ask, "What should we do in this phase?" Understanding positioning is more important than predicting price. Risk plus reality check. Bitcoin cycles are not identical. Macro conditions change. Liquidity shifts. No model is perfect. That's why institutions focus on adaptability, not certainty. Bitcoin doesn't reward emotion. It rewards understanding. Institutions don't win because they predict perfectly. They win because they respect cycles, manage risk, and stay patient. If you want to survive and thrive in Bitcoin, stop reacting to price. Start understanding where you are in the cycle. If this video helped you see Bitcoin differently, subscribe for more data-driven crypto insights. And I'll see you in the next one.